So first off, I want to clear a couple of misconceptions. This class is not supposed to, it's not going to make you a professional M&A modeler. Let me clear that out of the way. The essence of this class is first off to just give you a kind of high-level overview of how it works. That's the first thing. The second thing is that I think there are a lot of classes that already teach you how to be like a professional modeler. So I'm not going to be repeating what they are going to do. Essentially, I'm not going to be teaching you how to be an expert on Excel. There are classes that offer you that. That is not what this class is for. Thirdly, one of the most important things that makes this class very important is that I have worked with a couple of people who are more concerned about being beautiful on Excel rather than understanding why they are doing what they are doing. So the essence of this class is to teach you how to think. That's essentially what this class is for. It's going to teach you what goes into the numbers that goes into an M&A model. That's essentially what this class is for. So this class is not to, again, let me repeat it. It's not going to make you an expert. That's not what this class is for. I think a couple of people are already expert, and there are a lot of resources that can make you an expert modeler. The next one, again, as I said, is not going to teach you Excel, essentially how to be elegant on Excel. That is not what this class is for. Then what this class is for is going to teach you how to think about mergers and acquisition. Essentially, what are the thoughts that goes into the numbers? That's essentially what this class is for. And with that, we'll get started immediately. So what is M&A? Simply put, M&A essentially is a company. Merger and acquisition, essentially one company acquiring another company and them coming together to be one. It's just like a marriage of companies. That's what M&A is. And from a financial perspective, we analyze mergers and acquisition using what we call an M&A model. So an M&A model essentially is a financial analysis of the structure of what companies that combine look like afterwards. For some of you that are accountants, you understand what I mean. So just like a marriage where a man and his wife come together and they become one, when two companies come together and become one, for the public or what a finance person sees is that he sees like their books, their financial statements coming together. And what we do before we engage or before we go ahead with that kind of marriage, quote unquote, is that we analyze what the effect of that merger or acquisition is going to look like. Before I go very far, there are a couple of reasons why companies, come together essentially or merge. There are a couple of reasons, and I'll divide these reasons into two. Because we are finance people, definitely the easiest way to divide things is financial and non-financial reasons. So there are two major financial reasons why companies essentially come together. The first one, the first financial reason is that, one, the seller is undervalued from the point of view of the buyer, essentially. So I think another way to structure this conversation is, why does a company buy another company? A company buys another company because it believes that the seller is undervalued with respect to how much he is going to pay for it. So this particular conversation, we have to step back and think about it. If I feel like say Dangote is worth $1 billion, and then I buy it for, it's worth 10 naira, and I buy it for 8 naira, I'm getting a good deal from my own point of view. So for me, I got a good deal. Another person might believe that Dangote is worth maybe 12 naira, and the person pays 10 naira for it. The fact that I think that Dangote is worth 10 naira and I paid 8 naira for it, and the other person paid 10 naira while he thinks it's worth 12 naira, does not mean that it is undervalued on an absolute term. So value is relative. That's the first thing I wanted to point out. Value is relative, and that is some of the things that reflects when you are doing your M&A model. So value is dependent on how you are seeing it. That's the first thing. The second financial reason why companies combine, or why a company buys another company, is because they believe that the earnings per share after combination is higher than the earnings per share when they are a standalone entity. And I want you guys to put this at the back of your mind. So two financial reasons. First one is growth. We believe that this particular company is worth more than it is it's worth more than we are going to buy it for. Secondly, we believe that the earnings per share we are going to get when we combine with this company is higher than what we are currently getting. And I want to spell these two things out very well, especially the concept of earnings per share. For M&A, earnings per share is the holy grail of analysis. What I mean by that is whatever we are doing in an M&A analysis or in a merger model is to go to what we call earnings per share, EPS. What is earnings per share? In simple terms, earnings per share is essentially how much you earn from a share of a company. You can count that as the can count that as the benefits of you get when you that accrue to you when you buy a company or when you own the share of a company. And the simple calculation for earnings per share essentially is the total earnings of a company divided by the number of shares of the company. It is that simple and straightforward. Those are like the two important financial reasons why companies buy another company. But I want to caveat something. There is no company that buys a company for financial reasons. Let me just put it out there. So our job as finance people is people make decisions and we just want to help them feel like the decision they made makes sense. So one of the things you should not think as a young professional is that your work matters. It actually matters. Don't get me wrong, your work matters. But honestly, people don't buy companies because of the merger model tells them to buy that company. No. People buy company for reasons that are beyond just financial. So that takes us to the next one, which is non-financial reasons why people buy companies. So the non-financial reasons are like a lot. There are so many. One of them, which is very popular in the tech space, is essentially intellectual property. So I see a company and I feel like I want to acquire its intellectual property. The easy way for me to do that is to buy that particular company. That's one. Secondly, there's something called acquihire. Acquihire essentially is you buying a company because of you want to get its talents. I know it's very, very popular among some of these companies that are building innovative or what other people think is innovative kind of companies. What they just do is they just acquihire. They just buy the company and just get its staff. Those are another non-financial reason. Another one again, which is very popular, is ego. I buy a company because of I have a big ego. It makes people look at me in a kind of way. That's one reason again why companies buy another company. Another one is competition, crushing competition. And I think a big example of this particular one is Facebook acquiring WhatsApp, acquiring Instagram. So the reason behind that was not financial. There was no financial reason for acquiring those companies. It was mostly because of they wanted to crush the competition. That is another fuzzy reason, call it like non-financial reasons why companies buy companies. So from a finance perspective, what is our responsibility? Our responsibility is that when CEOs decide to buy companies, we help them make sense of it from the financial perspective. That's essentially what we do. That's our job. And that is why we get paid as finance people. And that is the kind of thing, that's essentially the crux of the conversation we are going to be having today. So just a quick segue. I think recently there was a news that I think it was Bankley. Bankley just recently got acquired by, I think it was a venture fund that acquired Bankley. So one of the things that came to my mind is when you look at that particular acquisition, the first thing that should come to your mind is that why is it that a venture company is buying why is it that a venture company is the one buying Bankley? Why is it not like a bank or another kind of fintech buying Bankley? So that brings me to one important point: is who buys a company, or who are the types of people that acquire companies or that are involved in a merger or an acquisition? They are mostly two different groups. They are grouped into two broad categories. The first ones are called sponsors or financial sponsors. The second group are called strategics. So financial sponsors, who are financial sponsors? Financial sponsors are essentially private equity companies, venture capital companies, companies that essentially manage money. They don't acquire companies because of they want to integrate the company with what they are doing. They acquire company for purely financial reasons. Now, that now takes me back to the first point. Remember, I told you that no company buys a company for financial reason, but that is not the entire truth. There is a new class of buyers or acquirers that are very active in the market that buy companies for financial reasons, and they are the ones that take this merger model very seriously. So when you decide to go and work, when you decide to go work for, like, some of these financial institutions, many more in an M&A capacity, many of the M&A analysis you are going to be doing is mostly going to be for financial sponsors. And why is it that what is it that makes financial sponsors different from strategic acquirers, or who are even financial sponsors? As I said, they are mostly private equity companies, venture capital companies. As I told you earlier, there was this news that came up that Bankley got acquired by a venture capital company. So that venture capital company, essentially, we could infer that that venture capital company bought or acquired Bankley for financial reasons. And financial reasons essentially means that if we are buying them, the price we are paying is lower than what we think they can give to us, or what we think we can get from it. And secondly, as I said, EPS, the earnings per share, the earnings we are going to be getting per share of Bankley, combined with what we currently have, is going to be better than it being on a standalone. But this creates a very, very interesting problem, because Bankley is not a publicly listed company. So it might be slightly difficult for us to be able to get like what the earnings per share of Bankley essentially is. But we'll get to that shortly. The first point, again, the other point I wanted to talk about is the next group of acquirers or acquirers, which are like, they're called strategics. So strategics are essentially companies, they are mostly corporate bodies who buy these companies, and they are hoping to get some strategic benefits from acquisition of these companies. A perfect example is Facebook acquiring Instagram, Facebook acquiring WhatsApp. Facebook in itself is seen as a strategic, because they acquire these companies because they believe that there are some benefits that are non-financial, at least in the short term, that they could benefit from acquiring some of these companies. And typically, strategics pay higher than sponsors when it comes to an acquisition. They typically pay higher, and the reason why they pay higher or what justifies this high valuation for this acquisition essentially is what we call synergies. So what are synergies in simple terms? Synergies are essentially benefits, financial benefits that you get from integrating one company with another one. So in simple terms, when you are adding the financials of two companies, 1 + 1 is supposed to be equal to 2. But in an acquisition where there are synergistic advantages, 1 + 1 will be essentially greater than 2, potentially greater than 2. And it is because of this thing in theory, this particular benefit in theory, that's why you see strategic acquirers tend to pay higher than financial sponsors. So just to reiterate and ensure that this point goes home, is that when you are asked a question, or when you are in a conversation, or even when you see a deal, one of the things you are going to see is that one of the things that you should be looking out for is that when financial sponsors acquire a company, the valuation of the company that they acquired is typically lower than when another company, a corporate is buying another company. Again, I'm saying this in a very loose sense. And the reason for this is what I told you about. Some of these companies, they can be able to integrate these companies into their already existing platform. I will give a practical example. Say Dangote is acquiring BOA, for example. Dangote would want to pay a lot more for BUA cement than, say, I don't know if we have any, like say a Verod acquiring BUA. And why would they do this? It's very simple. BUA is a competitor. If I acquire BUA, I can be able to either shut down the entire BUA plant and increase my price. Then I can potentially control the market and sell way more. That's one of the non-financial reasons. So I'm not even utilizing BUA for anything, but just closing it. The second thing I can do is I can be able to, like, utilize the factories of BUA, produce more, but because of I am in control of the market, or I'm essentially in charge of the entire market, I can again increase my price and control again. So the fact that we can be able to get advantages of control makes us somewhat irrational when we are trying to acquire a company from a corporate or from a strategic perspective. Most times, these ideas we have in our head does not pan out. But again, as human beings, we have to do what we have to do. But that is like, what the conversation is at that particular level. Now, let's go down to finance and why we are here, or what makes merger and acquisition an interesting conversation. From a finance perspective, our responsibility is to see if a deal makes sense before it happens. We have to analyze what is the potential impact of this deal going to look like when we combine these companies from a financial perspective. And in very, very simple terms, the steps we take to engage in, to go through, like, a merger model is essentially, it's just 5 simple steps. So whatever financial model you are building, whatever thing you are doing, don't forget these 5 simple steps. Again, before I go into the steps, there is one important thing I actually want to talk about, and that is, we talked about a company acquiring another company, but one important thing we also have to talk about is, what exactly is the consideration? What do they pay when they are buying these companies? As finance people, we know that there are 2 ways that we essentially finance our assets. We finance our assets from 2 main means. One is from debt, the other one is from equity. So like the 2 main ways we finance assets. In the same vein, that is essentially how we finance an acquisition. When we want to acquire a company, we can acquire a company mostly from 2 means. One is we use cash. We just buy the company outrightly. The second one is that we use stock. Essentially, we can use our own stock to acquire a company. So there are 2 different currencies when it comes to an acquisition or a merger. 2 different currencies. The first one, as I said, is cash. Essentially, the cash sitting on your balance sheet, or the cash you get from debt. Secondly, is your stock, or the equity you have. So what that means in simple terms is that a Dangote can decide to buy a BUA and not issue cash. It can issue its own shares to the BUA shareholders and essentially acquire BUA. Why this consideration is important is because it is what flows into our merger model. Because the underlining principle of merger and acquisition is that, from a financial perspective, now I'm talking financial, is that the amounts we paid for this company, is it going to be justified financially? And the way we analyze this is that the cost of acquisition has to be lower than the benefits, or the intended benefits we are going to be getting. That is essentially what a merger model and what a merger model, or what an M&A, what a merger model essentially tells us. That's what it analyzes. It analyzes the cost of acquisition versus the potential benefit of that acquisition. And if we are analyzing the cost of an acquisition, it is important for us to know what the consideration, or what we are paying for, is. So I will start with the first consideration. The first consideration is cash. What is the cost of cash? The cost of cash, in simple terms, essentially is, I think I've been doing a monologue for a long time now. I think I'll start opening the floor for questions. I'll start throwing questions so that at least the audience can participate. So again, as I said, what is the cost of cash? The cost of cash essentially is, if you have cash in your balance sheet, what should you be? What people typically do is they just put that cash in their bank account. and it should be earning an interest. And that interest is usually like, because they have to call that cash very quickly, the interest it typically earns is very, very low. So in finance terms, we call it like, we use what we call the risk-free rate. Risk-free rate essentially is just a simplification for saying that this is the least interest you can be able to earn if you put this asset in a government security. It's usually a proxy. But if you can be able to get the market interest rate, if maybe you put some money in Access Bank accounts and you can call it very fast, and you guys agreed an interest, then it is that interest that you use as the cost of cash. And in the pecking order of consideration, cash is usually the cheapest. It's usually the cheapest. It's the cheapest form of consideration. So when you want to, like, what is the cost of cash? The cost of cash is essentially equal to the interest you would have earned if you have put that money in the bank account. That's the first element of cost. So if I am buying a company with cash, what I'm going to be comparing is the cost I paid for that cash. Say the interest I paid for that cash, for that particular company. I compare it with the potential benefit. What is the potential benefit in this case? The potential benefit in financial terms is the net income that I'm going to be getting. So if say I buy a company for 100 naira and I paid cash, and if I have put that money in the bank, I would have been earning 10%, say, per year, 10% per year. So that means the cost of that cash is 10 naira. That's essentially it. So cost, it's there. I compare it with the potential benefit I'm going to be getting from this company. So the potential benefit from company B, let's say the net income of company B is 10 naira too. I'm just assuming now 10 naira. So what that essentially implies is that the cash I paid for this company, 10 naira, is equal to the benefit I would have been getting for this company, 10 naira. Equal. So I am indifferent at this particular point. So the next thing I'll start asking, is it worth it for me to continue from the financial perspective? But remember, this analysis is simplified because of I used cash. There are certain disadvantages of using cash, and you see the reason why a couple of companies do not use cash to like buy companies. They don't use cash to buy companies. You see the disadvantage in a second. But can somebody just preempt me? I want to throw a question out. This question is actually a paid question. Why is it that companies have a lot of cash, but they don't usually use cash to buy companies? Deborah.
Okay, thank you very much, sir. I think, please, can you hear me? Okay, companies have a lot of cash and they don't use it to buy company. I think because cash is a liquid asset whereby it can be used for their day-to-day activities. So that they can use it for their day-to-day their operational activities. I think that's why they don't really use cash to buy companies, sir.
That is true, but there is also another very important point. Remember, one of the things I want to instill in you as finance people is always think in terms of costs and benefits. And as much as possible, make it very, very quantitative. Because at the end of the day, everything in the finance system revolves around costs and benefits. That's essentially what it is. This particular one you mentioned is very, very important, liquidity. But let's say a company's working capital is small and it has like, its working capital is 10 million and it has 50 million in its bank accounts. It can buy a company for 40 million, for 30 million, even 10 million, but it does not do that. Instead, it uses another option. There's a reason why. And I think we've talked about this before. I will repeat it again. Number one is when you buy a company with cash immediately, there is going to be a tax implication for the buyers, for the sellers. Sorry. So immediately the sellers receive that money, they are going to immediately be subject to either a capital gains tax or any other. I'm not a tax professional, but there are a lot of tax implications once you buy a company on a cash basis. That's why I see companies avoid it. They don't want to do it, or they just do a mix. Secondly, when a company uses cash that's from the seller's perspective. From the buyer's perspective, when they buy a company, they don't have any shield that they would have gotten if they've used like debt to acquire it, any tax shield. And I think this is not the first or second or the third time I'm talking about tax shield. For people that have been attending some of this, and you understand what I mean by tax shield. Tax shield essentially comes when you utilize like debt to buy debt for an acquisition or debt to do any particular thing. So the shield that you get that essentially reduces your taxable profits because of the interest payments you are going to be making. You don't have that particular cover. So that's the reason why you see people, even though cash is the cheapest in terms of cost, people don't use it. So the analysis that happens is this. Okay, if the cost of cash is going to, now I compare the cost of cash versus the benefits, that's the net income you are going to be getting from acquiring that company. That's the analysis I did at a very simple level. But even if you want to go more granular, if you want to go more sophisticated, what we are going to do is we'll look at cash, we'll look at debt, we'll look at stock, we'll compare the cost, and then we'll look for an optimal cost that will compare that optimal cost to like the income, the net income or the benefits you are going to be getting before we make a decision. That is the analysis we are going to be doing like from tomorrow. So from tomorrow, yeah, we'll just walk through like 2 or 3 simple examples so that you can be able to like internalize it and essentially understand exactly what I mean. But from a high level, we are comparing the cost of cash versus the project, the income we are going to be getting. That's what we do. But again, we talked about like, you know, a reason why, even though this particular thing works out, why people don't use it, because when you're not looking at second level or indirect effects, like one of them is like tax implication you are getting from the buyer, from the seller side, and the fact that you are not going to be getting a tax cover or a tax shield if you had used debt. It now becomes like cumbersome. Then the next thing again you use again, instead of cash in your balance sheet, is cash that you collected from a bank or from a lender, debt. So that is also cash. You collect the debt and then you essentially pay the person. Or you even or potentially you issue debts to like the public and use that to buy a company. Essentially, the major difference, the important factor of debt is the fact that you're paying a coupon, like a compulsory payment. There's a compulsory payment called a compulsory cost called interest that you have to pay. That's essentially what makes debt slightly different from cash. But again, you are issuing debt and getting cash and then paying that particular company. But remember the advantages of debt I just talked about. You have an interest, you have the tax shield. Essentially, taxable profit you will have been paying will be reduced to a level on the basis of the tax rate, essentially, and on the basis of the interest payment you're going to be making. It becomes attractive, slightly attractive, even though it is more expensive compared to cash. Why companies now get debt and use it to acquire companies? Again, the analysis you do is that what is the cost of this debt? The cost of this debt essentially is the interest payment. Oh, I collected debt of 100 million, and then my my interest payments per year is 10%. So that means my interest payment is 10 million. You compare that 10 million to the net income you should be getting, or the net income of that company you want to buy. So once you look at the income statement of that company, the net income is 10 million per year. You compare both of them. If the 10 million you are paying in terms of debt, of interest payment, is higher than the net income you'll be getting from the companies. When you just look at the company's financials, you just see that the net income is essentially higher than the cost you are paying. In that particular case, it means that the benefit you are getting makes sense. But if it is lower, it doesn't make any sense for you to go ahead with that. That's essentially the simple analysis that a merger model does, or you see what a merger and acquisition is trying to measure from a financial perspective. Then the last particular currency or consideration is equity. That's stock. You issue your stock, and then you issue your stock. Again, as I said, your stock is also a currency. But in the hierarchy of cost or of ones that are most expensive, it goes like this. Cash is the least expensive. Next is debt. Then the most expensive usually is stock. So you see a company will issue its stock and then use that particular one to use that and use that stock as a currency to acquire the company. Again, we go through the same analysis. What is the cost of a stock? The cost of stock is what we call price per earning, or PE ratio. That's essentially the cost of stock. So you essentially, in simple terms, it is the price I pay per unit of stock. That's essentially what it is. Price I pay per unit of stock. That is usually seen as, that's usually used as the metric of the cost of a stock. You compare that particular price per earning to the potential benefits you are going to be getting from buying this company. But in this case, it is not just net income, because there is a dilutive effect of issuing your shares, or your own particular shares. Now, this takes me straight into the next thing I wanted to talk about, which are like the 5 steps of a merger model. If I'm moving too fast, please let me know. I'm trying to ensure that we hit a particular we finish this content today, so that tomorrow we just start, like, we just start making everything very concrete. That's why I'm kind of like rushing. But if I'm rushing, if I'm moving too fast and you feel like there's something that you do not understand, just let me know, and then I'll go back. So what are like the 5 steps of a merger model? This particular 5 steps I want to talk about, please, it should be like a grill. It should be ingrained somewhere. Just go and ingrain it somewhere. Go and write it somewhere. Like, it's not something that you should forget. Don't ever forget it, because it's going to be somebody said he has a question. Go ahead with your question. I think I can take a question now, because the next part is something that is very important.
Yeah, good evening.
Yeah.
Thank you. So my question, you talked about financial sponsors and you made for matters like acquisition in terms of financial reasons.
I'm struggling to hear you.
Wow. Can you hear me now? Is it better?
Yeah, much better.
Okay, so my question is, you made mention of how we can. You made mention of reasons why a company purchase for matters as our acquisition. You talked about financial and non-financial reasons. So you also made mention of financial sponsors and strategies, right? So I want you to make more clarification on strategies particularly. So the strategies you made mention of on strategies particularly.
Okay. Strategics.
Yes, strategics. So you made mention of synergy, right?
Mm-hmm.
Can you hear me?
Yeah, I can hear you. Go ahead with your question.
The main question is, for financial model, we can really, financial model basically talks about figures and all of that. But for strategics, we might not really have quantitative measure for it. So in building financial model, what are the quantitative measures that we use to value company under strategics? Do you get the question?
Yeah. I get the question. Okay, yeah. So let me clarify. So what I mean by strategics buying companies for non-financial reason, as a when you are modeling some of these things, one of the things we've learned how to do is to essentially get creative about some of these things. And then I'll tell you what I mean by that. Usually, when it's strategic, or even when a company wants to buy another, apart from financial sponsors, even though financial sponsors are going in that direction now, when a company wants to buy another company, they will say, I want to buy that company. Your financial model, if your financial model say that deal is not going to be accretive, if your financial model even say that the deal is going to be dilutive, they don't care. They will go ahead and buy that company. That's just the truth. That's how it works. And then we'll figure it out. But as a modeler, some of the things we tend to do is that we tend to quantify some of these benefits from a financial perspective. And how do we do this? We do this in ways we do this quantification in what we call, sometimes we call it revenue synergies and cost synergies. What these things means in simple terms is that if this company combines with this particular company, there are some costs we are going to share. Does it happen in reality? Rarely. Does it happen really? Is the impact really much? Not so much. A practical example is when Access Bank bought Diamond. When Access Bank bought Diamond, the assumption is that the leadership of Access Bank is going to be in charge of the entire group. So there's no need for you to have a leader in Access Bank and also a leader in Diamond. So the cost of the leader in Diamond is going to go off in the combined income statement. So because the first income statement, the first line of the income statement is you add the revenue of this company plus the revenue of this company to give combined revenue. The cost is you add the cost of this company with the cost of the other company. But the cost, when you're adding the cost of the other company, you now see, oh, management is like going to be duplicated, so you just erase one of the management. So in the combined income statement, what you are now going to see is just the management cost of just one. So that is in the combined statement. Now you see that you have eliminated that cost. So building, let me say for example buildings, let's assume that building at this point in time, the net book value of building is 0. I'm just throwing numbers here randomly here, so don't hold me to that. And we are not going to use those buildings for anything, or maybe it's costing us something, or maybe electricity costs. We take that off because we believe that all of them are going to come into our own building. So these things are called cost synergies. Cost synergies essentially is the fact that upon combination of companies, of two companies, you are going to get certain cost advantages. You essentially are going to spread the cost you should have actually that have been for these two entities. You just use only one and you eliminate the other one. So those are called cost synergies. That's what we typically do. So we just look at companies and say, okay, this particular company and this company, they have common costs or common lines that could be used or could be common to all of them. We eliminate this particular one and then we are getting a benefit from the combined perspective. That's how to model that. But you need to have a very good story to talk about it. Usually, as I said, does that happen like every single time? Not, it happens, but is the impact really worth so much? Not so much. That's the realistic answer. So we'll still try to like model from a cost synergy perspective, but it doesn't really mean that the impact is very significant to justify that acquisition. That's the first thing. The other one is revenue synergies. Revenue synergies essentially is that upon combination of those companies, they could have like the example I gave with Boa and Dangote, they have pricing power, so he could increase the price. So if he increases price, that's a revenue synergy. The implication of that is that because of you combine with this company, you can be able to charge more and then you make more revenue because of that combination. We'll also model that if we're able to have a very good story to explain it. So those are like the two common ways, cost synergies and revenue synergies. Those are like the two common ways to quantify those kind of strategic acquisition. Did that answer your question?
Yes, it does. Thank you.
All right. One more question. I can take one more question before we go ahead. It seems like I'm moving too fast today. Since today nobody's asking any question. I hope that.
So I'm just curious. For testimony, I'm just curious. So why would a company want to be sold, seeing that they also have potentials of staying in business and also being competitive? Why would, for example, WhatsApp allow Meta to buy them over when they can also compete? So is it all about the strategy? Is it all about what works best for them per time? I'm just curious to know.
Okay. So the answer is both financial and non-financial. So there is this question is actually a very funny question because of something a conversation I was having with a friend recently. Sometimes when let me start from the financial, since we're in a finance class. So the thing is this: you value your company. you know what your company is worth. Remember, I started this meeting to say that value is relative. So to me, my company is worth 100 million. Maybe to someone else, the person believes that it's worth way more. If the person gives me 100 million, let me tell you what value is, what valuation means. When I value my company, I mean that if I am working on this particular business, the entire potential of that business, the money it can generate over its lifetime, discounted to the present value, if I'm using a discounted cash flow method, or if I'm using that's essentially what valuation means. The potential amounts the potential that this thing have, in your own word, the potential that this company has is worth $100 million to me. If somebody gives me $100 million, I'll take it and walk away, because the person has matched the value I placed on this business. That is the financial reason. As I said, it is because of people have different perceptions of value. That's why they can have a deal. The value of education to you might be higher, or it's even higher compared to that of a school. That's why you are willing to pay a school to get educated. So it is the same principle even in business. The second non-financial reason, or some people are just tired of running the company. Again, the way we model this tiredness is in terms of value. We try to say, oh, this guy is tired. To him, this business is not worth the stress. When we value that particular thing, if there's a way we can value stress, the business is worth less compared to maybe a big player that has a lot of resources and I can keep running that particular company or running that engine and generate more money. Thirdly, again, it could be because of they believe that they've exhausted their abilities. They just feel like, oh, at this point, WhatsApp, for example, WhatsApp knew that the easiest way for them to be able to get distribution was to combine with Facebook. That was it. WhatsApp was very, very popular in developing countries, but not so much in developed markets. Facebook had the resources, Facebook had the technology, Facebook had the people. So it was easier for them. They believe that together they will be better. That's another reason, the way they think about it from boardroom perspective. So when companies sell another company, they sell it for a lot of reasons that are financial and non-financial. But at the crux of it all is a question of value. The value you are giving to me and the value I place, do we reach a middle ground? Once we reach a middle ground, I'm going to sell the company. It's that easy. Sometimes some people are even fired. Sometimes even a hostile takeover, but I don't want to go into that. But the crux of the matter is that it's a question of value. Once there's a value match, a sale can happen. Did that answer your question?
Yes, sir. Thank you so much. Yeah.
Good. So now the 5 steps of a merger model. Again, I want to emphasize this and say this. A merger model, essentially, or merger analysis, is that you are analyzing the financials of 2 companies and you want to determine if them coming together is going to be accretive or dilutive. What I mean by accretive and dilutive is just a fancy term for saying that if the deal makes sense from a financial perspective or not. So another name for a merger model is what we call accretion dilution analysis. So if you hear someone that says, if you hear accretion dilution analysis or a merger and acquisition model or a merger analysis, they all mean the same thing. So there are 5 major steps in a merger model. As I said, if you want to write this down, write it, commit it to memory. Tomorrow I'll put together a deck and then send across after our class tomorrow. So there are 5 steps. But let me define what a merger model is. The definition, again, as I said, is that a merger model is used to analyze the financials of 2 companies. We also analyze the purchase price, essentially, at what price are we going to pay. We analyze the consideration, debt, cash, and stock. And then we come to a determination of if the deal is accretive or dilutive. That's what the merger model does. So the steps are, number 1, you make assumption about the acquisition. That's the first thing you do. And the assumptions you make about the acquisition is you make assumption about the price you are paying. Essentially, the merger model comes from two sides, but I'm talking about the merger model from the point of view of a buyer, not from a seller. That's the first thing you should establish. So from the point of view of a buyer, a seller does the same thing from the other side, but a seller does not really care about the value to the buyer, doesn't care. So the only thing a seller just does is valuation. I just value my business and see how much is my business worth. This is the amount you're going to pay me for it. But from a buyer, what the buyer does is that they make assumption about the acquisition, first step. And the assumptions they make is they make assumption about the price they are going to pay, and then the consideration. That's the first step. So the second step again is, the second step after that is they now do evaluation of, they do evaluation of themselves, and they also do evaluation of the seller. You can use the different kind of valuation methods to do that. Discounted cash flow, the market, precedent transactions, but we'll talk about valuation much later in the future. But the simple thing you should just know is that they do evaluation of the buyer and the seller. And then the intention of that valuation is they want to get the shares outstanding of the buyer and the seller. That's the intention of that valuation analysis. Then the third thing you do is that you project income statements for both of them, from the buyer and the seller. Project an income statement. And then after you've projected the income statement, the next thing you do, which is the fourth step, is that you combine the income statement. So the trick in a merger and acquisition is how you combine the income statement. It's essentially how the income statement is combined. That is where the trick comes into play. So combining income statement is not like plain vanilla 1 + 1. No. But there are some things that are easy addition. For example, you have to add the revenue of both companies. You add the operating expenses for both companies. Then to one of you's question, which talked about synergies, you also have to adjust for synergies. You start making the adjustment for synergies. Those synergies are like, again, if you are working on a particular merger and acquisition deal, you'll be able to understand from your senior what those synergies could potentially be. One of them is the admin expense I talked about, maybe office expenses, electricity bill. So you have to do those adjustments for synergies, because you don't just add them. You can just pick one and leave the other one. Then you adjust for synergies. You also adjust for foregone interest on cash. Remember the interest I talked about on cash, which is like the cost of the cash. You also account for the cost of debt. Again, what is going to determine all these adjustments is the consideration. So if it is just a cash deal, the only adjustment you are going to do is the foregone interest on cash. That's it. But if you used cash and debt, then you have to adjust for the foregone interest on cash, adjust for the interest you paid on debt. That is if you use cash and debt. But if you use cash, debt, and stock, which is typically what a lot of M&A deals are about, then the adjustment you are going to make for stock is going to be the last thing that will happen afterward. That's going to be like the fifth step. So after you've done the adjustments you've adjusted for the foregone interest on cash and the interest you paid on debt, you now get to, remember that you are combining the income statement. You now get to what we call combined pre-tax income. That means that combined pre-tax income, you've not applied tax. You've just added the pre-tax income of those entities. When you add the pre-tax income of both entities, for you to get the post-tax income of both entities, you apply the buyer's tax rates to the seller's net income, quote unquote. The reason why I'm saying net income, quote unquote, is because this net income has already been adjusted. So if the buyer's tax rate is 25% and the seller's tax rate is 20%, usually M&A deals at this particular level will be happening in the same jurisdiction, so they will be subject to the same taxes, the same level of taxes. But if it is in different jurisdiction or in different industries, you have to use the tax rate of the buyer to apply to the adjusted net income of the seller. That's a very, very important thing that will come to when we are working on this tomorrow. Then we'll now get the combined net income of the combination. And then when we get the combined net income of the combination, we get to the important metric I was talking about, which is EPS. So we get the EPS, that's the earnings per share of the buyer. We compare it to the combined EPS of the buyer and the seller. And that combined EPS is very, very, very important. I can't even stress it enough. The combined EPS is very, very important because the combined EPS is equal to the net income of the buyer plus the net income of the seller minus foregone interest on cash minus foregone interest on debt minus or plus synergies. All of them are divided by the shares outstanding of the buyer plus shares outstanding of the seller. That is what a merger and acquisition is essentially. I will say this again. EPS, when you are comparing EPS, the EPS of the buyer essentially is EPS is earnings per share. So earnings is net income divided by shares outstanding. That is EPS. So if you have the net income of the buyer 100, I think we can do an example very, very quickly so that it's not theoretical. Let's just do an example very quickly so that this is not, so I don't lose people. Let me just do an example very, very quickly. Okay, let me do an example very quickly. So the steps, as I said, the first step is let me talk about EPS first. EPS is the most important thing again, is the most important metric when it comes to merger and acquisition. So earnings per share, let's say buyer's net income is equal to, let me say 1,000. And then buyer's shares outstanding is equal to, let me say 100. Then let's say seller's net income is equal to, say, I want this to be 200, and then seller's share outstanding is equal to 200. This is a simple transaction. So let's assume buyer wants to buy seller with cash. Wants to buy seller with cash. Let's say at par value. What at par value means is that you are buying it and you are not paying anything extra. You don't want to pay anything. You are just buying the seller based on the value that the seller asked for. That usually does not happen in principle, but I want to demonstrate what combined EPS is so that we understand it and why it is different in different scenarios. With cash, combined EPS is going to be totally different. With cash, let's say with cash at par, we say we have to, let's say the value is the value of the seller is 100. Let's just assume that it's 100. Now let's go through our merger model. We might not be able to do all those entire steps for this particular one because we don't have revenue, income, and whatever, but we can do the last part, EPS. So the EPS of the buyer's EPS is very simple. That's what we'll start from. Calculate the buyer's EPS. The buyer's EPS, again, as I said, EPS is earnings. Net income is also called earnings divided by share outstanding. This is the buyer's EPS. Very simple. This is essentially what a merger model is based on. Buyer's EPS is 10. which is earnings divided by share outstanding. We compare this buyer's EPS to the combined EPS. So, and the implication of that is, in simple terms, what that means from fundamental is that you are saying the amount I'll be earning from my own share, the amount I'm earning from my own share should be lower than what I should be earning when we are combined together for the deal to make sense to me. That's essentially what it means in simple terms. So now combined EPS is we add the net income of the buyer plus the net income of the seller. But remember that we spent money to be able to use this cash. And the money that we spent to use this, the money we spent is called interest. So we have to deduct that cost from the net income. We have to deduct that cost from the net. And that's what that particular thought process was telling you about. You add the revenue of the buyer to the revenue of the seller, and then you add the the costs of the buyer with the cost of the seller, but then you now adjust for some of those items. But what is going to determine the adjustment is your consideration. Remember, in this particular case, we used cash, and the cost of cash, as we said, was like interest. So the interest we are paying for cash, essentially, let me just assume that this particular, we are getting this facility for 10% per year. And so what we do is we subtract 10%, which is the cost, multiply by what is the amount we paid for this particular company. We paid the value 100. So this is now the updated earnings. Then you divide these by earnings per share. The share is going to be the share is going to be the share of the buyer. Then something is wrong here. Did you get it right? Okay. Well, did we get this right? Yes. I think it's because of the numbers that I used. Okay. Now, what you are seeing here is that the buyer's EPS is 10, but the combined EPS is 2,000 and whatever. This is a very, very large number, but it's because of essentially the way that we arrived at this. So in this particular case, our decision rule is very simple. The buyer's EPS is 10, the combined EPS is 2,000. This particular deal, our decision is like very, very simple. It means that this deal is accretive, so we should go ahead. In simple terms, it means that if we combine with this company at this particular price, what we are going to be potentially earning per share of our company is 2,000 as against 10, which we are currently earning. So this deal makes sense. That is essentially what EPS analysis is. This particular thing is going to change if we use debt. With debt, if we use debt for this particular acquisition, it is going to be slightly the same. But in this case, what is going to determine the net income, or what's going to determine the adjusted net income, is going to be the interest we paid for debt. So let's assume that the interest we paid for debt is, let's assume in this case, maybe the interest is say 20%. Let's assume that the interest is 20%. So let's say assume that the interest we paid for is 20%. We still do the same thing. The buyer EPS does not change. The buyer's EPS does not change. It is still the same net income of the buyer divided by the share outstanding of the buyer. It doesn't change. But the combined EPS in this case is going to change slightly. The combined EPS is going to be the net income of the buyer. Always remember that you are adding their net income plus the net income of the seller minus the cost of the consideration, in this case, debt, multiplied by the value. Then this number is going to change. Then we divide this entire number by, okay, I think something was wrong with the other one. Now I see what is wrong. We divide it by the share, we divide by the share outstanding of the buyer. 29. I think that's what was wrong here. Was a very large number. Good. It makes more sense now. 29. So even with debt, if we had used debt to buy this company at 20%, when we compare the buyer EPS to the combined EPS, it still makes sense to go ahead with this company, with this acquisition from a financial perspective, because the costs we are incurring, 20% in principle, it's small compared to the potential benefits we will have gotten from this particular company at this price. Remember, everything is dependent on price. If I had said that we bought this company at a 20% premium, essentially this conversation would be totally different, because 20% premium means that even though the company is worth 100, we are paying 20% more, 120, and our analysis, essentially the 20% will be taking 20%, we will not be taking just 20% of the value at par, we'll be taking 20% of the price that we paid. But now, let's assume the last thing I'm going to do today before we call it a day is with stock. Everything now changes. If we used stock to buy this particular company, our analysis changes slightly. Again, we still do buyer EPS. Buyer EPS is still 10. It does not change. I hope I'm not moving too fast. We compare these to combined EPS. Our combined EPS now, we still go with our net income, the two net income, this plus this. Let's just stop there for now. And now, what now happens? Remember, in this case, we did not use cash. We did not use debt. What we did was we issued our own stock. That's what we did. So the first thing we have to get, for us to be able to understand what the dilutive effect is on our own particular stock, we need to understand how much is our stock worth. Let me assume that our stock here is worth, our share price is, let me say 10 for simplicity. Our own share price is 10. How much of my share worth 10 do I have to issue to give these people a value of 100? Because what it means that I'm paying them 100. That's what I'm doing. I'm paying them 100, but I'm paying them from my own stock. So I'm going to give them, I want to dilution. I'm very horrible at spellings, sorry. So I want to know how much of my stock am I going to give these people to buy their company. Their company is worth 100. But I want to pay them using my stock 10. So how many of my stock will I give them to be able to compensate them for 100? Just the value divided by my share price 10. So I'm going to issue 10 of my stock to them. This 10 stock I'm going to issue to them is going to cause a dilution, a dilutive effect. And because of I'm paying with stock, that is when this thing is now going to reflect underneath here. Remember, we are doing combined earnings per share. We've added the earnings. Now, the total shares outstanding for me as an individual now is my shares plus this additional share I issued. Again, this deal is still accretive for me. But in this case, it even seems that even from this particular case, one of the things it's showing me here now at first glance is that my stock is cheaper than using cash and debt. But again, it's because of a lot of reasons. I did not use like the tax shield on debt and cash, but we'll talk about that one tomorrow. But why I wanted to illustrate this here is that the important analysis for M&A is that you are comparing the buyer's earnings per share to the combined earnings per share. And what determines the combined earnings per share is the consideration. If you use cash, if you use debt, if you use stock, it's going to change. So that is where I'm going to stop for today. Tomorrow, we'll continue and we'll go into questions. Do you have any questions for me?
Yeah, I think there's a question in the chat box. And then some people want to add their eyes and stuff.
Some people want to what?
Some people have their hands raised up. They have
Okay,
their hands raised up.
Samuel Koka, question Akinleye.
Yeah, no, not really a question. It is just based on the calculation you just did concerning the stock option, because I feel I want you to first put in the figure you use in dividing into a bracket if the figure will be different, because I saw that if we do 3,000 divided by 3,000 divided by 100 would have given us 30. That would now be plus 10, which will give us 40. So I think if you had put it in a bracket, you might have gotten the exact figure.
Oh, I see. Okay, that's what. Oh, thank you. Thanks for that. Yeah. Yeah, I think you're correct. Yeah, 27. Yeah, which is expected. Thank you. Akinleye. Sorry.
Yes, Akinleye, thank you. Thanks for the amazing practical perspective. So my questions is, okay, if we are consider with cash, or yes, if we are considered with cash or probably with debt. So I want to ask that, is it only the interest on both consideration applies, or maybe probably there are other costs of that consideration in terms of maybe probably tax implication and all of that? Is that, let's take tax implication as a typical example. Is tax implication is not going to be added to that cost of consideration while we are making the EPS analysis?
Yeah, definitely tax implication is going to be added. And I think that's one of the caveats I gave, or maybe I did not say it loudly, because of this was for illustration purposes. Remember when I was talking about why we use debt, why debt is is a preferred security, or is a preferred tool for acquisition, is because of the tax benefits. By tax benefit, I mean like the fact that it reduces your taxable income. It has this tax shield. So definitely we have to include that, because what that does is that it's going to lower the cost. So if, for example, in this particular analysis we did, we were just taking like the entire 100% costs, the entire 100% of the interest. But if, let's say, in a Nigerian regime where tax is 30%, it is just 70% impact that is going to hit that particular number. So it will be 70% of the 10, which is 7. So our cost would have been 7, not 10. Does that make sense? So definitely the tax impact is going to be addressed, but I did this for illustrative purposes only. So maybe when we're working tomorrow, we'll drill down into those things. Deborah.
Okay, thank you very much, sir. So my question is, EPS measured in naira value or in kobo value? Because in ICANN classes, they told us that it's in kobo value. So yeah, now I'm seeing 10, 40. So I just want to know. Thank you, sir.
Well, I'm not so one of the things I'm a very, very terrible instructor when it comes to currency units. What I know is that it's measured in currency units. And again, it's essentially dependent on 2 factors. Remember, the numerator and the denominator. Your numerator is net income. If your net income is in naira, and then your shares outstanding is in units, it's going to be naira over the units of shares, naira per share. That's essentially what it's going to be. But why they are telling you kobo is because at the end of the day, those net income, once you divide it by that number, it's essentially going to be in very, very small naira value. So instead of having something like 0.1 naira, you just say 10 kobo. Instead of having 1 naira, you just say 1 kobo. Do you understand? So I think it's just a case of semantics. But the essence of this class is just to tell you like the idea behind it, or how you essentially evaluate these decisions. It's less about how grandiose you are with like all those 10 kobo or whatever, but more about how when you look at these numbers, How do people arrive at it? But even at a bigger level, how do people evaluate these decisions from a financial perspective? That's essentially what matters. So one of the things this can tell you from the high level is that I think Nigeria's NPR, I'm not sure what the NPR is now. Somebody, if you know, you can tell. I think it's 27, but let me just assume 30%. So in an environment where you know that the interest is 30%, from a strategic perspective, you have to think very critically to collect a facility of 30% to buy. Whoa. You have to think very 27.5. Thank you. You have to think very critically to collect a facility of 30% to either engage in a business or even buy a company. Let's even say engage in a business. So now the implication of a facility of 30% or 27.5% means that for you to collect that money to do any business at all, that business should have the potential of giving you more than 30% per year. That's essentially what it means for you to collect that facility. That also goes to a decision of acquiring a company. If I'm going to acquire this company, go through this operating stress, and I am not getting a value that is more than over and above 30%, it doesn't make sense. That's essentially what happens in valuation too. You look at the cost you are paying, either in terms of, and again, the cost is even beyond this interest and whatever. We've not even factored in fees and all those other costs, but I don't want us to get very complicated. But the point, the overarching idea is that I compare the costs versus the benefits. What determines the cost? It is the consideration, the cash, the debt, or the stock. What is my benefit? The net income I'm bringing in. You just compare those two at that level, and then you get you essentially make a decision. All right. Deborah, go ahead. Ask your question.
Thank you very much. Thank you very much. Please, I also want to ask, is this step also, this merger and acquisition model, is it the same as us for if there is merger? I'm not talking, this one that you list for us now, I think it's for acquisition. But what about merger? Can we also use this step for merger condition?
Okay, mergers and acquisition is the same thing. Their difference is just semantics. And again, just to be very sophisticated, merger essentially is when two companies of almost the same size combine. That's it. Simple. Traditionally, anyway, there's a different definition from a financial perspective, but I don't want us to complicate that. The next thing for acquisition is when a company is outrightly buying a company. When they are buying it outrightly, and usually there's a difference in size, but the same analysis happen either you are buying or you are merging or you are acquiring. But just to take a step back, remember when I was talking about sponsors and strategists, I told you that financial sponsors are people that buy companies for financial reasons. Those sponsors are usually the ones that do acquisitions the most, because they just acquire these companies. They are not merging it to anything, except for new companies except for new kind of private equity companies that do what we call roll-ups. So roll-ups essentially is that a financial sponsor, like a private equity or a venture capital, buys a company and they roll it up with an existing company they have within their portfolio. They merge them together internally. So they are the ones that they are the new kind of mergers that happen. But usually, the simple thing is that sponsors are the ones that do acquisitions. Strategists do mergers. They just merge a company. They just merge with the other. If the company is big enough, it's not big enough, they acquire it outrightly and do whatever they like with it. So it's more of a semantic thing. But for the financial analysis, we go through the same kind of analysis when we are analyzing if the deal makes sense or not financially. Again, the caveat I'm putting is that most companies do not buy companies for financial reasons. So that's one of the things you have to put in your mind. It is not your model or your analysis that is going to make them buy a company. But it just helps to know it and know how to think through things, because after we are done with this class, the projects that we're going to work on is we actually combine two companies. We'll combine two companies and then give our recommendation on if, from a financial perspective, we think if they come together, it's going to be like accretive financially. We can just do the financial analysis, maybe not strategic.
Yeah, so there's one question in the chat box somewhere.
Oh my God. We are supposed to end this meeting in the next 3 minutes, and I'm going to have a hard stop at 3 minutes. So try our best to answer as much questions.
Yes, so this is just last question. So it says
What was
your analysis by cash. It said in your analysis by cash, I saw a 10% in the computation of the combined EPS. What does the 10% represent?
You saw a 10% computation in my, again, as I said, in combined EPS. I'm not sure I saw any 10% in combined EPS. I'm not sure I saw any 10%. But again, let me just, so that we don't get boxed down in detail. If we want to use percentage, even though EPS is not in percentage, let's assume that earning per share, you are earning 10% per share. That's essentially what it means in principle. You are earning 10% per one share. So one share is giving you 10% income, quote unquote. You combine that 10% you are earning with the costs that it will take you to buy that company. So if you are earning 10%, if you are potentially earning 10% from that company, you potentially will earn 10% from that company from a combined perspective, 10%. And you are going to get a loan of 10% to buy. Without the tax implication, when you combine both, it does not make any sense for you to go ahead and buy that company. But if you could potentially earn like 12% from an earning per share perspective, and then you are paying 10% without even considering tax, then it starts making financial sense for you to go ahead. That's what it means in simple terms, in very simplified terms. I don't know if that answered the question. One last thing, one last question. Okay, that will be all for now. Thank you very much, guys. I really enjoyed spending time with you today. Tomorrow we'll go ahead and come with your questions. Take care of yourself. Bye-bye.